Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, NRG Energy, the competitive power company that wired 6 million American homes and then added a smart home security system to the deal.
NRG was founded in 1989 as a subsidiary of Northern States Power. It emerged from bankruptcy in 2003 and listed on the NYSE as an independent competitive power company.
The 2012 GenOn acquisition doubled NRG's generation fleet to roughly 18,000 megawatts. Adding retail brands like Reliant, Direct Energy, and Green Mountain Energy built a customer base few rivals could match.
Then came the pivot that surprised Wall Street. In 2023, NRG paid $2.8 billion for Vivint Smart Home, adding a security and automation platform to its retail lineup, creating the only bundled Energy Plus smart home offering in the U.S.
CEO Mauricio Gutierrez has led NRG since 2015, rising from a gas trading career within the company. The Vivint bet was his boldest move, and integration results are showing in customer retention metrics.
Texas led with $11.1 billion in FY 2025. East added $14.3 billion. Vivint Smart Home contributed $2.1 billion, while West and other operations added $3.2 billion.
Total revenue reached $30.7 billion in FY 2025, up 9% year over year. Gross margin sits at 22%, consistent with competitive power economics, while operating margins tightened on higher Vivint integration costs.
NRG serves roughly 6 million retail energy customers, one of the largest competitive retail books in North America. Vivint adds approximately 2 million smart home subscribers on top of that base.
NRG reinstated its dividend in 2019 after restructuring and has raised it every year since. The current annualized payout is approximately $1.90 per share, 6 consecutive years of increases.
That 6-year streak puts NRG in a select group of utilities that grow their payout rather than just maintain it. The yield near 1.3% is modest, but it is backed by structurally growing free cash flow.
Raising the dividend through a major acquisition integration signals confidence in the combined platform's cash generation. Management is not waiting to prove the Vivint thesis.
Against Vistra and AES, NRG's smart home angle is genuinely differentiated. Retail bundling creates switching costs and customer lifetime value that pure power producers simply cannot match.
NRG's Texas dominance through Reliant is also structural. In the deregulated ERCOT market, brand recognition and customer relationships are hard-won assets that NRG has spent decades building.
The broader network spans power generation plants across the U.S., retail offices in every major deregulated market, and Vivint service teams in hundreds of cities, a multi-line footprint competitors cannot quickly replicate.
Gutierrez studied chemical engineering before earning an MBA from Rice University, fitting for a CEO running power plants. He has spent his entire career at NRG, rising from a gas trading desk to the C-suite.
His decade-long tenure brought financial discipline, reinstating the dividend, expanding retail brands, and making the calculated bet on smart home convergence before it became an obvious play.
That foresight positions NRG as more than a utility. It is a home services platform with a power backbone, a combination no other U.S. energy company has fully executed.
NRG's Q1 2026 results are in this morning. With the Texas grid running hot heading into summer and Vivint gaining traction, the Power Plus smart home story is about to come into full focus.
NRG Energy delivered a massive revenue beat in Q1 2026, 22.1% above consensus estimates. The EPS miss of 16.3% reflects Vivint Smart Home integration costs and one-time charges, not operational deterioration. Strip the integration noise, and NRG's retail electricity business is executing at a high level. AI data center power demand is the secular driver. This is Charged Alpha. I'm Hudson.
And I'm Lana. NRG Energy is one of the largest integrated power companies in the United States, operating retail electricity brands including Reliant Energy, Green Mountain Energy, and Stream Energy, alongside wholesale power generation assets. NRG serves approximately 6 million customers across retail electricity markets, primarily in Texas through the ERCOT grid and across deregulated markets in multiple states. The 2023 acquisition of Vivint Smart Home added home automation, security, and energy management products to NRG's residential customer relationships. market cap is approximately $11 billion.
CEO Mauricio Gutierrez has led NRG since 2015 and championed the Vivint acquisition as a strategy to deepen customer relationships beyond electricity billing into recurring smart home subscriptions. Gutierrez's thesis is that NRG's existing 6 million customer retail electricity base represents a distribution platform for Vivint's connected home products, creating a higher value customer relationship than commodity electricity alone.
Starting with NRG's financials, Q1 2026 revenue beat the consensus estimate by 22.1%, driven by strong retail electricity margins, favorable weather patterns that increased heating demand across the Texas ERCOT market, and Vivint subscription revenue contribution. The revenue beat is the headline metric that the Street focused on, as it reflects NRG's operating performance more directly than the EPS miss.
Adjusted EPS missed the consensus estimate by 16.3%, reflecting Vivint integration costs, acquisition-related amortization, and one-time charges from the smart home build-out. These costs are expected to decline as the integration completes. Management has provided a timeline for Vivint milestones that would reduce the quarterly cost burden and allow smart home contribution to flow more clearly to the earnings line.
The Texas ERCOT market is NRG's largest and most important business. ERCOT is a deregulated electricity market where retail electricity providers compete for residential and commercial customers on price and service. NRG's Reliant Energy brand has significant market position in Texas, and favorable weather, extended cold periods, or extreme heat events creates demand spikes that benefit retailers with well-managed supply hedges.
The Vivint acquisition adds a recurring revenue layer to NRG's customer relationships. Vivint smart home subscriptions, security monitoring, automation services, and energy management generate monthly recurring revenue per customer that is less weather-dependent and more contractually predictable than electricity margin. The cross-sell opportunity, offering Vivint products to NRG's existing electricity customers, is the core synergy thesis behind the acquisition.
AI data center power demand is an emerging tailwind for NRG's wholesale generation assets. Hyperscaler construction in Texas requires massive, reliable baseload power contracts, and NRG's generation portfolio positions the company as a potential counterparty for large-scale power purchase agreements. Bears who model AI demand as a commodity benefit see NRG as an indirect AI play through elevated ERCOT wholesale prices.
Management maintained full-year guidance after the Q1 print, noting that Vivint integration costs are on track to decline through the year. The revenue beat and maintained guidance signal that the core retail electricity business is performing well, even as the integration charges weigh on the near-term earnings headline. Management's commentary on the Vivint integration timeline will be the key indicator to watch in subsequent quarters.
The analyst community's reaction to NRG's Q1 result is mixed, but leaning constructive. The 22% revenue beat signals that the retail electricity business is performing at a high level. The EPS miss from integration costs is well understood. Analysts modeling the Vivint integration timeline will watch cost reduction milestones rather than treating the miss as structural.
The constructive analyst view centers on the Vivint synergy potential. If NRG can successfully cross-sell smart home products to its 6 million electricity customer base at even modest penetration rates, the recurring subscription revenue could materially change NRG's earnings quality, from a commodity electricity retailer to a diversified energy services company with predictable recurring revenue. Bulls model the Vivint integration as the primary re-rating catalyst.
AI data center power demand is a second constructive thesis. Texas has become a primary target for hyperscaler data center investment, driven by available land, low regulation, and existing power infrastructure. NRG's generation assets and ERCOT market position create optionality as large-scale power purchase agreements for data center facilities become available. The AI power demand story adds a secular growth angle to what would otherwise be a commodity energy company narrative.
The skeptical view focuses on Vivint integration risk. NRG paid approximately $5.2 billion for Vivint, a significant premium for a smart home company that operates in a highly competitive consumer technology space. If Vivint's cross-sell economics are weaker than management projects, or if the smart home subscription market faces competitive pressure from Amazon, Google, or Apple, the acquisition could represent capital destruction at a material scale.
ERCOT market risk is an ongoing analyst concern. The Texas electricity grid experienced a catastrophic failure during Winter Storm Uri in 2021, a regulatory and reputational event that highlighted the structural vulnerabilities in the ERCOT market design. Grid reliability improvements have been made since Uri, but ERCOT's isolated structure and summer peak demand concentration continue to create event risk for market participants, including NRG.
The bull case for NRG starts with the Vivint cross-sell opportunity against 6 million electricity customers. Smart home penetration at even 5% represents 300,000 incremental Vivint subscriptions at monthly recurring revenue per customer, carrying far higher margins than commodity electricity. Bulls model the integration, delivering a step change in NRG's earnings quality once costs normalize.
AI data center power demand is the upside optionality in the bull case. As hyperscaler investment concentrates in Texas, wholesale ERCOT prices will reflect data center load growth in ways that benefit NRG's generation assets and retail supply hedges. Bulls modeling AI as a multi-decade demand driver see NRG's Texas position as one of the most direct utility sector beneficiaries.
The dividend and buyback program provides capital return discipline, while the integration thesis plays out. NRG has maintained shareholder returns through the Vivint integration period. Income investors collect yield while waiting for Vivint synergies and AI power demand to create a higher quality earnings base supporting a premium valuation multiple.
The bear case for NRG leads with Vivint integration risk. Smart home is a competitive consumer market where Amazon Alexa, Google Nest, and Apple HomeKit dominate mindshare. Vivint's subscription model, requiring professional installation and a multi-year contract, faces disruption from DIY alternatives. Bears modeling Vivint's competitive position weakening see the acquisition as capital destruction.
Commodity electricity margin risk is the second bear concern. Retail margins in ERCOT face regulatory changes, competitive entry, and weather normalization. An extended mild year, without extreme cold or heat events that create demand spikes, could compress NRG's earnings below guidance. The Q1 revenue beat may partly reflect favorable weather rather than structural improvement.
ERCOT event risk remains a tail risk for NRG. A repeat of a Winter Storm Uri-type grid failure, with extreme cold weather exceeding available generation capacity, could create massive market disruption, regulatory intervention, and potential default scenarios across the Texas electricity market. NRG's ERCOT concentration means this tail risk is not diversified by geography.
Balance sheet leverage from the Vivint acquisition constrains NRG's strategic optionality. The acquisition added debt that limits buybacks, dividend growth, and additional investments. Bears modeling integration costs taking longer to resolve see NRG's leverage as a persistent constraint on shareholder return capacity and re-rating potential.
Vistra Energy is NRG's most direct peer in Texas retail electricity and wholesale generation. Both operate in ERCOT and compete for the same customers. Vistra has expanded its zero-carbon generation assets, creating a different strategic positioning than NRG's Vivint integrated model. Vistra trades at a comparable multiple with less smart home integration overhang.
Constellation Energy is the large-cap power generation peer with a significant nuclear fleet providing zero-carbon baseload generation. Constellation's power purchase agreements with hyperscaler data centers have driven strong stock performance as AI demand became a mainstream thesis. NRG's Texas position creates a different AI exposure, wholesale ERCOT pricing benefits rather than direct PPA contracts.
NextEra Energy is the utility sector's premium multiple benchmark, combining regulated Florida utility operations with a massive wind and solar development pipeline. NextEra doesn't compete directly with NRG, but provides valuation context for how the market rewards diversified power companies with clean energy exposure. NRG's integration execution will determine whether it earns any premium above commodity power multiples.
On valuation, NRG trades at a discount to regulated utilities and clean energy peers, reflecting commodity margin exposure and Vivint integration overhang. If integration resolves and synergies materialize, NRG could re-rate toward Vistra's multiple. If AI data center demand in Texas accelerates wholesale price support, NRG's generation assets add earnings upside above current models.
NRG's options market activity heading into Q1 2026 earnings was elevated, reflecting uncertainty about how Vivint integration costs would flow through the EPS line. Pre-earnings implied volatility was above sector average for utilities, consistent with the binary nature of integration cost reporting. The revenue beat partially offset the EPS miss in the post-earnings stock reaction.
Post-earnings implied volatility compressed as the result resolved the near-term uncertainty. Options market activity following earnings showed a split between investors focused on the revenue beat and those focused on the EPS miss, creating a volatile post-earnings trading session. NRG's beta of approximately 1.4 positions it as a meaningful market amplifier within the utility sector, where most names are below market beta.
Insider activity at NRG reflects CEO Mauricio Gutierrez's conviction in the Vivint acquisition thesis. Gutierrez has maintained his equity position through the integration period without notable open market sales, a signal that management retains confidence in the long-term synergy realization. Scheduled plan transactions are the primary filing pattern in the most recent 90-day window, consistent with normal compensation-related equity management.
The combined read from options and insider data is cautiously constructive. Elevated pre-earnings implied volatility reflected genuine Vivint cost uncertainty that the revenue beat partially resolved. Insider holding patterns signal management confidence in the integration timeline. For NRG, the thesis turns on Vivint synergy realization and Texas power demand growth. Q1 provided positive signals on both.
NRG's Q1 2026 revenue beat of 22.1% demonstrates strong operational performance in retail electricity and Vivint growth. The EPS miss is integration noise, not operational failure.
Bottom line, the revenue beat is the signal and the EPS miss is the noise. If Vivint integration costs normalize on schedule and AI data center power demand in Texas accelerates, NRG is materially undervalued at current multiples.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall